Hello. Welcome to Option Bank, your premier options trading platform. In this video, we shall discuss what is a bond, its characteristics, and bond issuers. When a company needs money, it can use two basic means to obtain financing: debt financing and equity financing. While equity involves the issuing of shares which represent partial ownership and contain a high level of risk for the buyers, debt financing occurs when a firm raises money for working capital or capital expenditure by selling bonds, bills or notes to individuals or institutional investors, instead of obtaining loans directly from a bank. So, what is a bond? A bond is a type of long-term debt investment in which an investor, also called the buyer of the bond, loans money to an entity, called the issuer. The buyer can be an individual or an institution, and the issuer can be a company or national government. The investors lend the funds for a defined period of time, at a variable or fixed interest rate. In return for that money, the issuer provides its creditors with a bond in which it promises to pay back in full, with regular interest payments. The market price of a bond depends on several factors. These are the credit quality of the issuer, time until maturity, and the coupon rate. So what are the characteristics of bonds? Face value or par value is the money amount the bond will be worth at its maturity. Par value remains fixed, and is different from the price of the bond. A bond's price fluctuates in the market in accordance with changes in interest rates. Coupon rate is the rate of interest the bond issuer will pay on the face value of the bond, expressed as a percentage. The interest rate paid to a bond investor, purchaser is a fixed, stated amount, but the bond's yield, which is the interest amount relative to the bond's current market price, fluctuates along with price. Maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. Maturities can range from as little as 1 day to as long as 30 years. Coupon dates are the dates on which the bond issuer will make interest payments. Issue price is the price at which the issuer originally sells the bonds. It may or may not be the same as its face value. We now come to the final part of this week's video: bond issuers. There are three main categories of bonds: corporate bonds, municipal bonds, and government bonds. Corporate bonds are issued by companies. The backing for the bond is typically money to be earned from future operations. In some cases, the company's physical assets may be used as collateral for bonds. Corporate bonds are considered higher risk than government bonds. As a result, interest rates are almost always higher, even for companies with top-rated credit quality. Municipal bonds are issued by states and cities, or civic bodies within states and cities. These bonds offer tax-free coupon income for investors. Government bonds are issued by national governments around the world, for example US Treasuries, German bonds, Japanese government bonds, and British gilts. Government bonds are considered risk-free and are traded in highly liquid markets. Next time we shall dig deeper into this topic by discussing varieties of bonds and how bond prices fluctuate in the market. In the meantime, you are welcome to visit Option Bank and open a free demo account to have a first-hand trading experience with bonds and many other instruments. Thank you for watching.